Welcome back. Today we are going to talk about how to use factor models to come up with very meaningful estimates for covariance matrix parameters. Remember that we are facing the curse of dimensionality and we need to reduce the number of parameters. It turns out that using a factor model is a very reasonable way to do this. So, here is a typical kind of factor model decomposition of asset returns. We are trying to explain asset returns in terms of the asset exposure with respect to underlying risk factors. And we're going to assume in this case that we have n assets, let's say 100 stocks, and we have a smaller number of factors. Say we call it k, the number of factors. The k could be something like 3, 4, 5. I mean, some reasonable parsimonious factor model that we're going to be using. Now, we can use the factor model doing some straightforward kind of mathematical development. We can use the factor model to get an expression for the variance and the covariance of stock returns based on the factor models. So for example, what we find is the variance in a given stock, it can be obtained as a function of the beta of the stock with respect to the factors, and also as a function of the variance of the factors. Again, we're also involving in general the covariance between the factors, but very often we are trying to do our best to look at and to use uncorrelated factor returns. So the covariance that covariance term might actually be 0, as we will see in a moment. We can do exactly the same for covariance parameters. And the mathematical expressions will tell you again that what we need to have is estimate for the betas of the stocks and the variance of the factors. And if you have the betas of the stocks and the variance of the factors, then we can get a good estimate for the covariance term. Now, if you're looking at the expression carefully, you also see that you have to deal in that expression with the covariance between the specific returns on the stocks, whatever fraction of stock return that's not explained by the factor model. That specific return is denoted by epsilon I and epsilon j for stock I and j. So we also need the covariance between these two terms. And here is the point. That's very important here. Here is the point where we are going to start introducing some structure. We are going to make an assumption. We are going to make the assumption that specific risk on those two stocks are uncorrelated. So we are going to cancel out that term. We're going to say that term should be 0. Now, in reality, if you try on a given sample, the data would tell you that that term may not be 0. Well, the problem is if you have to estimate, covariance between specific returns on many pairs of stocks, then you're back to square one. You're not reducing the curse of dimensionality. So the key assumption here, and that's where we're introducing some kind of model risk, we're assuming away this kind of correlation between specific returns. Now, when you think about it, if your factor model does a good job at capturing the commonalities in stock returns, then by definition of what we mean capturing the commonalities, whatever remains is actually specific to stock I and stock j. So if your factor model is well specified, assuming that the specific components are uncorrelated is not too bad an assumption. It's not too much of an assumption because everything else, everything that they have in common has already been taken care of by the factor model. Now, that was the two-factor case. You can have a general decomposition in the k-factor case. And again, if you're assuming uncorrelated factors, what you find as a conclusion is, if you start with 100 stocks, for example, you need to, and say 5 factors, then you need to estimate betas for each stock with respect to each factor. So that's 100 betas with respect to each factor. So that's 500 betas. So what's the conclusion? Well, the conclusion is to estimate the covariance parameters. You only need now 500 parameter estimates, betas of 100 stocks with respect to 5 factors. It may sound a lot, but remember that if you don't do something like this, you'd have to estimate 5,000 parameters. In other words, we have reduced the curse of dimensionality by a factor of 10, And we've done so in a fairly meaningful way. So the next question that remains is what kind of factor models we are going to be using to do so. Well, you can use the simplest factor model, the one that's kind of the most basic one, which is a single factor model, where what you're doing is you're regressing the return, say, on individual stocks, for example, on the return on the market. And you get a single beta in this case. So that's something that you can do. Of course, if you do so, you will be concerned that assuming away correlation between specific returns will come with a big cost in terms of simplifying assumption, because we know that there's more than one common factors impacting asset returns. There are typically multiple factors, common factors impacting asset returns. So it's probably better to be using some kind of a factor model, multi-factor model. There are three families of multi-factor models. The first one is the so-called explicit macro factor models. So where you could be using something like inflation, growth, some kind of interest rates, term spread. So you're using kind of macro variables. So we call them macro factor models. You could also be using micro factor models. In other words, you could be looking at attributes actually, or characteristics of different stocks, and thinking of these characteristics as a way to try and explain differences in risk parameters. These characteristics could be something like country, industry, size, book to market. I mean, the typical attributes that people can be using and have a meaningful influence on stock returns. And finally, you could be using an implicit factor model, where you're not even imposing your view on what the factors should be, and you're letting the data through some kind of statistical analysis, like some kind of principal component analysis. The data is going to tell you what the factors are. And typically, you're going to constrain the statistical analysis to generate orthogonal, uncorrelated factors, which, as we said, was helpful for parameter estimates. Well, let me say that you actually have professional provider of risk models that will give you, under the form of a dedicated software, give you access to all of these kind of fancy ways of estimating covariance parameters through a given factor model. And most sophisticated asset managers, that's exactly what they use. They use some of these, some of these techniques and models. Okay, in terms of wrapping up, well, using a factor model turns out to be a fairly convenient way to reduce the number of parameters, because you're not doing it in a completely ad hoc manner. You're only assuming that whatever is not explained by the factor model is kind of very specific to each stock and therefore uncorrelated stock by stock. That's the only assumption you're making. So as long as your factor model has done a good job at capturing the commonalities in security returns, then you're going to be okay. You're going to get a pretty good estimate for your parameters. Now, in practice, there's a tendency to believe that using an implicit factor model can be giving you kind of the best trade-off, if only because you're not imposing any structure or any explicit view on what the factors should be. You let the data tell you. And as long as this is implemented in a robust way, hopefully this will allow you to address the curse of dimensionality fairly efficiently. Welcome back. For the last few lectures, we've been looking at how to address the curse of dimensionality, the fact that there are very many parameters to estimate, risk parameters to estimate, and we have to reduce the number of parameters. And we've done a pretty good job at introducing methodologies that allow us to do this with a fairly meaningful and robust way. Now we're going to switch to the second problem, which is the curse of non-stationarity, the fact that each one of these risk parameters may be time varying. Okay, so let's start with a very simple case where there's a single asset. So there's no curse of dimensionality at all. There's a single asset that we are looking at. And we are interested in the variance or the volatility of that asset over time. Okay? So we are going to define sigma of t, the volatility, the daily volatility estimated at the end of date t. Let's say we're looking at daily data. So that's kind of the daily estimate for volatility today, at the end of day t today. And we're going to be doing this on the basis of a past sample. Okay? So your estimate today is essentially given by, if you're looking at the sample estimate, you're first looking at the mean return, R bar t, which is the average of past return from t equal 1 to capital T, which is today. And then you're looking at the variance of the return, which is essentially, 1 divided by t times the sum of the square deviation with respect to the mean. First of all, we are going to assume that the mean value for the returns is 0. That's, not a big oversimplification for high-frequency data, where we're looking on average at, kind of low returns anyway, right? So for daily data, it may not be a big deal. Now we get a very simple value for estimate of volatility, which is our variance. Sigma square t is given by the average of the square return. That's very simple, right? On a daily basis, you collect the returns, you square them, and you look at the average. Okay, let's do this, and let's take a look at actual data, and let's see what this kind of looks like in terms of actual data. So we're doing this on a trailing yearly window analysis. So every day, we look at the past year worth of data, and we move forward in time. And we are doing this from 1926 to 2018 using some kind of broad equity index. And here is what we find. Well, we find clear evidence that equity market volatility is not constant over time. There are periods when it's really high, periods when it's really low. The average should be somewhere around, I guess, 20%, but there have been periods of time when it went as high as 50, period of time when it went as low as 10 or even lower than 10. And so clearly there's a pattern, right? There's a lot of time variation in volatility parameters. So this very simple analysis suggests that, kind of assuming that volatility is constant over time is a big mistake. We have to recognize that volatility is time varying. And we have to account for these time variations when constructing our volatility estimates. Otherwise, we would be, making big mistakes. What are the implications in terms of volatility estimates? Well, first of all, one key implication is if you're trying to increase your sample size for, you remember, for the curse of dimensionality, that's always good, you may want to, increase frequency as opposed to be increasing kind of sample period. Because if you're increasing frequency, you're still going to be looking at relatively recent data. So it's better to use daily data for a year than taking a look at 10 or 20 years worth of, weekly or monthly data, if you will, right? In the end of the day, you're going to get as many data points, but with a more recent history, which is important because, again, volatility is time varying. Now, there's a limit on how much you can increase frequency, right? For stock returns, the most we can use typically is daily data. There are attempts at using intraday data, high-frequency data for coming up with better volatility estimates, and we have reasons to believe that might be an interesting way to go. But not everyone has access to these high-frequency data, and there's a lot of noise and technical problems with it as well, right? So if you're stuck with daily data and you're looking at a year worth of return, here is your concern. By looking at an average, by looking at an estimate based on this yearly worth, kind of yearly data, your volatility estimate will actually not be today's volatility estimate. It will be some kind of an average volatility over last year. Again, if volatility doesn't move around or move around very slowly, it's okay to use this past year worth of data. But if volatility changes and changes quite dramatically, you're kind of estimating an average volatility, averaging periods of very high volatility, while perhaps today we are at a period of very low volatility. And you're not going to recognize this because you're kind of using 1 year worth of data. So what you want to do in this case is looking at the trade-off between expanding window analysis and rolling window analysis. So let me explain the difference between the two. Expanding window analysis is a situation whereby as time goes by and you come up with new estimate for volatility, you're kind of expanding the window as the name says, and you're increasing sample size. That's called expanding window analysis. Now, rolling window analysis, on the other hand, keeps the constant, the size of the sample. And at every point in time, you're moving forward the window while keeping a given kind of a constant size. Clearly, if asset returns are stationary and volatility is constant, it's better to use expanding windows because that's going to give you eventually a bigger sample. Now, if, as is the case, asset returns are not stationary and volatility moves around, well, then there's a good case to be made that it's better to use rolling window so as to only look at the most recent data. Okay, let me wrap up. Well, we have very strong empirical reasons to believe that volatility is not constant but changes over time. In this context, it's much better to use rolling windows as opposed to expanding windows. Having said this, even when you use rolling window, you still have a backward-looking bias because you're using, the past sample worth of data to estimate volatility today. So next time, we're going to start discussing methodologies that can be used to give us more meaningful, more kind of forward-looking or at least current-looking estimates of volatility when we have a concern that volatility may be time-varying, which is most often the case.
All right, folks, welcome back. Today's lab session description is going to really just concentrate on one thing, and that is estimating covariance. So let's start with something that I think you've already done before, and the reason I want to recap that is because that's really the foundation. This is what you did last week, and that is let's build upon that backtesting framework that we built last week. So let's first load up the data. I have commented out these lines here because if you want to run it on all of the portfolios, then you can just leave it the way it is. But if you want to run it on just a subset of the portfolios so that you can print the results in the tables, you can do that way. You can just pick a set of industries and then limit yourself to that. So this is just there as a reminder to you that you don't have to do this on all 49 industries or 30 industries or whatever you like. Okay. I'm limiting myself here for a number of reasons for data since 1974. The reason people frequently do that in this particular data set, by the way, is because the methodology changed at a few points in time along the way, and 1974 onwards is sort of the most similar to sort of what we're doing. Some people use 1980 onwards, 1964 onwards, 1945, although the data goes back to 1926. So you could use all the data from 26 or these various breakpoints. So I'm just picking 74. You can meddle with that as well. Okay, so this stuff we've already seen. And the reason I brought this back is I just want to make the point that all you're doing is you're giving different weighting functions, right? So you're saying equally weighted. You're saying cap weighted. Well, we're going to add one weighting function, this time, and that is the GMV, or the global minimum variance portfolio. So what we're going to do is we're going to build the same weighting scheme. We're going to use the same weighting scheme. We're going to build several portfolios using the same weighting scheme with this minimum volatility, but minimum volatility requires an estimate of the covariance matrix. So we're going to give it different covariance matrix estimators. So this is the weighting function, or the weighting scheme. And the weighting scheme, we're now going to do a new one, and then we're going to hold that one fixed, which is the weighting scheme is going to be GMV, or minimum volatility. And then what we're going to vary is within that weighting scheme, we're going to vary different estimation parameters, okay? Different ways of estimating that covariance matrix. And we're going to see what does that do to the GMV portfolio, okay? Okay, so this is familiar stuff. I just put this here because I want to make sure you do this on this data, you get meaningful results, etc. So this is equally weighted and cap weighted. There's not as much difference here because I think it's because, there's many reasons why that could be true, but I think the reason I'm not seeing that much of a difference here is this time I'm using the equally weighted portfolios. So in other words, you're taking 49 equally weighted portfolios and then cap weighting that. So the granularity isn't enough to see that much of a difference. Make sense? Because the constituents themselves of each one of those sector portfolios are already equally weighted. Okay? But, there's a difference. So anyway. All right. So remember what we have to do to backtest any weighting scheme. All you have to do is build a weighter or weighting function. Well, this is your weighting function. Weight GMV. Okay, just like weight EW and weight CW, I've got a new one which is weight GMV. And weight GMV takes the same returns, takes the same covariance estimator, but it also takes this thing called keyword args. And keyword args, you can look this up if you haven't seen this before. There's a Python thing that says all the other, you can pass in a whole bunch of other something equals something, something equals something when you call it, and those are all bunched together into a dictionary here. Okay, that's it. It's as simple as that. Okay, so let's get back to this. So what is going on here? You are weighting it by trying to find the minimum variance. Well, that's easy because we've actually already written the code to do that in the last MOOC, right? But it needs a covariance matrix. So all we're doing here is we're calling that old function that we've been using with a covariance matrix that we're estimating using a covariance estimator that we're passing in as a function. And that function in this particular case is just sample covariance. Okay, so you understand the sequence of functions that's happening here. The backtester requires a weighting scheme function, or a weighter, think of it, right? So the weighting scheme function is GMV. Well, the GMV function requires a function which is how to compute the covariance, a covariance estimator. And so that covariance estimator in this case is sample covariance, and that is computed in this particular way, right? All you're doing is taking the returns, you're just computing the covariance that way. Okay, so what do you do when you get that? Well, you can add in a new set of returns, and all I'm doing is, again, converting them to an index, a wealth index, and I'm just plotting that wealth index starting from $1 and going all the way up. Okay, what do we see? So when we look at this, we find that, well, maybe let's just look at one or two things. The volatility of the equally weighted and the cap weighted portfolio are almost the same, about 18% for the reasons that I told you before. But then look at that. It's the GMV portfolio is a little more than half, right? And you can see that, hopefully you'll see it. Yes, you do see it here in terms of the drawdown as well. You've gone from something in the 58 to 59% down to about 33%, right? So, by the way, great case of why people like minimum volatility portfolios, right? And so the Sharpe ratio, of course, is through the roof, not because of the excess returns, which in this example happens to be, you have excess returns as well, but it's largely because of the, well, in this case, it's both. It's the decrease in volatility as well as the excess return. So it's really fantastic. Then we can try other estimators. So I've got constant correlation. Constant correlation is, let me walk you through this code. All I'm doing here is first I'm taking the correlation function. I'm computing the correlations, right? And then I am computing the average of all the off-diagonal elements. And this code, you might have to stare at it a little while before you get it. But basically, the correlation matrix is a symmetric matrix, right? So what I'm going to do is I'm going to compute the sum of all the values, right? But the diagonal is all ones. So I have the sum of all of those elements. I got to take that out. So that's why I'm subtracting n from that. Okay. And then I've got now n squared minus n entries that have been summed up, right? So all I want is the mean of that. So the mean correlation is that number minus n squared minus n, and that's the same as divided by n times n minus 1. Okay, so that's how I compute the mean. So now I know what the mean correlation is. So all I do is I construct a new correlation matrix, which is CCOR, the constant correlation matrix. I just fill it up with these row bars, right? So with the average, and then I fill the diagonal with ones, right? Because if I just looked at this, it would be a matrix that is all filled with row bar, including the diagonal. We don't want that. We just want everything other than the diagonal to be row bar, and we want the diagonal to be 1. Okay, and that's essentially what this is. Yeah. So, and then of course you have to regenerate now from this new set of correlations. You want to regenerate the covariance, and the formula for doing that, there's two ways of doing it. So one is there's actually a function in stats models that does exactly that, but it's so simple that you might as well know how it's done, and that's the formula for it, right? So, and that's actually an implementation of that. Okay, so good. So that's basically how that works. And if you run that, I've run some diagnostics here. You should be able to see what that's doing. You should be able to look at the weights. Well, I will let you look at these numbers and play around with them, change them. They will all change when you change either the number of industries or the time period, etc. So please do spend some time playing with it. That's really the main point of these labs, and to look at the code so that you really understand it. And you can see here that at least in this example, the constant correlation matrix really didn't have that much of an improvement. It was about the same as the sample covariance matrix. Right? There are other reasons why this may be a good choice, but at least over this period on this data set, remember, we're not working with individual stocks here, we're working with portfolios already. There could be a number of reasons why we didn't see a dramatic improvement. When we work with portfolios, a lot of the noise has already been wiped out. Does that make sense? When you're looking at individual stocks, a lot of the signal, there's very little signal and a lot of noise. In other words, there's a lot of idiosyncratic variance or idiosyncratic volatility in the stock price. When you start putting portfolios of them together, such as we're using here, you will start to see that idiosyncratic portions all wash out, all those noise components wash out, and you'll start to see more cohesive behavior, and it'll behave like a portfolio, because they are in fact portfolios. Don't be discouraged by this. When you do this on individual stocks, you will see very, very significant benefits by going with some of these techniques that I'm going to be showing you. And I really encourage you to play around. If you have access to individual stock data that you're working with at your job or elsewhere, it's a good exercise to run. Okay. Finally, I want to talk about statistical shrinkage. In practice, we introduced the idea of shrinkage between one and another, two different estimates. Very often, people will just use, instead of trying to pick like an optimal shrinkage number, they'll just use a number of 0.5 or 0.25. If they feel like the factor model is pretty good that they're shrinking towards, then they might use a slightly different number. So I've implemented this just using 0.5. You can change the delta and play around with it and see what it does to the portfolio. And the code to do this, you can see, comes down to that. It's delta times whatever your prior plus 1 minus delta times your sample. Okay. And you can look at how that does in terms of the shrinkage, and you can actually see it right here. This is the sample. This is the sort of covariance, constant correlation estimate, and you can see this thing is somewhere in between these two. Okay. All right. And then, of course, you can run a horse race, as we have. And again, you can see that this GMV with shrinkage sort of ends up, somewhere in between. It really is all sort of in that ballpark. Again, play around with these numbers. More important, I would say, is to look at the code and make sure that you really understand every step along the way. All right. Great. Well, thank you very much. Please do play with these things and change the data, use different data sets. We've provided a few variations of these data sets, so it's important for you to change the data sets and see what it does. Change the parameters, see what it does. That's really the main aim of these lab sessions. It's not simply for you to look at the code and watch the videos. It's for you to play with the code, and in particular, these estimators and how the backtest is done. Well, thank you very much. See you at the next session.
Welcome back. Today we are going to talk about expected return estimates, and we are going to argue that sample-based information is unfortunately close to useless when it comes to expected return estimation. Let me try and explain this unfortunate finding by looking at a very simple example. So in this graph, we see two portfolio values. In both cases, the portfolio starts at $100, and after 5 years, the final value is $150. Now, there's two contrasted situations. The portfolio in red is a portfolio that goes pretty smoothly, goes up from 100 to 150 in a fairly smooth manner. The other portfolio, which is depicted in black, is a portfolio value which goes around quite a lot. Now, dramatic decreases and dramatic increases in portfolio value, and in the end happens to end up at the same value, which is $150. Now, here is the problem. The problem is, if we're given those two time series, and if we are told that we should use a sample-based estimator for what's the expected return on those two time series, we are going to conclude that in both cases, the best expected return estimate we can come up with is plus 50%. Well, plus 50% over 5 years, that would mean plus 10% per year, if you will. Now, we find the exact same outcome for those two portfolios, even though the behavior was very different. One had a low volatility and the other one had a high volatility. Now, let me try and explain that this parameter estimate 10% annual return per year can be severely misleading, especially in the second case, in the case of the portfolio with a high volatility. Well, let's take a look at that portfolio, and let's assume that now we are repeating the experiment and just splitting the sample in half. And we're going to try and estimate expected return on those two half samples. Well, if you do so, by the end of the half sample, the first half sample, what happens is the stock return or stock price will have gone down a lot, right? So if we stop at the point where there's like this valley. So your parameter estimate at this point in time for expected return is actually not plus 10%, it's severely negative, which doesn't make really good sense, right? Expected return is probably positive at this point in time. Otherwise, nobody would be holding stocks if expected returns will be negative. So your expected return is just a reflection of the past performance. It doesn't tell you much information looking forward. And then if you look at the second half of the sample starting from this low point, then you go back up all the way to 150. That's a huge kind of improvement. So the bottom line is your sample-based expected return will be very sample dependent. Small changes in the sample will lead to large changes in the sample-based estimate for expected returns. And that's not going to be so much the case for the red portfolio, because that one is pretty smooth. Conclusion, sample-based expected return estimators are extremely noisy, especially for high volatility portfolios. So the confidence intervals are very large. We have very little confidence that the estimator that we come up with is of any meaningfulness. There's a very interesting paper by Bob Merton in 1980 that actually shows this problem in a very explicit and mathematical way. Okay, so what do we do then if we're stuck in this situation where, statistics is close to useless? Well, we're going to do something. We're going to forget about, statistics based on looking at sample. We are going to try and move forward and use another way of thinking about statistics. This other way of thinking about statistics is called Bayesian statistics. Now, here is the difference between the standard, also known as frequentist statistics analysis, and the Bayesian statistical analysis. In frequentist or standard statistical analysis, we assume that we know nothing about the outcome of the experiment before looking at the sample. So in other words, if I have a coin and someone tells me what's the probability of a head or a tail, I'm going to respond, well, I don't know. It is only if you allow me to flip the coin a few times, that I can tell you about, the probability. And if you flip the coin, let's say 10 times, and the guy says, yeah, why don't you flip the coin 10 times? And if I find 6 heads, for example, and 4 tails, I'm going to come to the conclusion as a frequency statistician that my best estimate is 60% heads, 40% tail. That's the frequency statistician. Everything they know about the data, they learn from the sample. Well, in contrast, the Bayesian statistician will recognize that before coming up to the statistical experiment, they have some prior knowledge. Well, if you give me a coin, I'm going to, assume that it's most likely than not a fair coin, right? And so I'm going to assume that, as a default option, if you will, before flipping the coin, I'm going to assume it's 50-50. And now, if you let me flip the coin 10 times, and if I find 6 heads and 4 tails, I'm not going to come to the conclusion that this is a 60-40 outcome. I'm going to come to the conclusion that it's still a 50-50% outcome, that this is a fair coin, because the outcome of the statistical experiment is not sufficiently dramatic to kind of lead me to upgrade or update my prior. I'm going to stick to my prior. Now, if you allow me to flip the coin not 10 times, but 1,000 times, and if I find 600 heads and 400 tails, well, then the situation is different. I'm now going to start to say, well, maybe it's very unlikely, starting from a fair coin, to find, 60-40 on that large a sample. So what I'm going to be doing then is I'm going to be okay in terms of upgrading my prior and mixing my prior with sample-based information. So what we're saying here has very important implications for expected return estimates. If sample-based information is close to useless, we need to rely on priors. Otherwise, we're stuck. We have nothing to rely upon. And given that sample-based information will not be very meaningful, the upgrade of our prior will be very minimum. So we'd better come up with good priors when it comes to expected return estimation. Well, let me give you an example, not of a very good prior, but an example of a very robust and agnostic prior. This agnostic prior is known as shrinkage methodology. It's a shrinkage methodology. It's known as shrinkage towards the grand mean. So let me assume I'm looking at n stocks, and I need to estimate expected return for each one of these n stocks. Let me call that mu I hat, the expected return on each one of them. And what I'm going to do is I'm first going to be estimating the average performance of every stock in the sample, and I get an estimate that I call mu I bar, which is noisy, and I know it's noisy. And then I'm going to look at the grand mean estimate, mu bar, which is going to be the average over all parameter estimates for the mean values of the return on each stock. So mu bar is the average of all the mu I bar. And then my mu hat estimate for stock I will be a combination, a mixture of the mu I bar, which is the sample-based estimate for each stock, which I know is noisy, and also the grand mean. And by shrinking the parameter estimates towards the grand mean, especially if you increase the shrinkage intensity, then you're going to get more robust estimation. Of course, if you let the importance of the grand mean converge to 1, the shrinkage intensity factor converge to 1, then in this case, you're going to force all parameter estimates to be identical. Well, that's the agnostic prior that we talked about, which would lead you to hold the minimum variance portfolio as a proxy for the maximum Sharpe ratio portfolio. Wrapping up, sample-based information is close to useless when it comes to expected return estimate. In this context, we've got to work hard and think hard to come up with meaningful priors, because that's about everything we can rely upon, and that's the only things we can rely upon. We've been looking at a very simple prior, which is kind of shrinking towards the grand mean. Next time, we're going to be using more economically motivated priors, trying to relate our expected return estimate towards some kind of meaningful risk estimate. Welcome back. Today we are going to talk about how we can use factor models to estimate expected returns. Okay, the first factor model that you may want to be using, the simplest of them all, is the capital asset pricing model, the CAPM. And if the CAPM is the true asset pricing model, then we have a very simple prescription in the sense that we know that excess expected return for a given stock is proportional to the beta of the stock, as can be seen from this equation. Now, this equation has a very simple implication when you think about it. It says that mu I, expected return on the stock, minus RF, the risk-free rate, divided by beta I, the beta of the stock. So that ratio, excess expected return divided by beta, which is known as the trainer ratio, well, the CAPM predicts that the trainer ratio is going to be exactly the same for all stocks. And the quantity that you're going to get in terms of that trainer ratio will be the market risk premium, mu m minus RF. And that quantity will be the same across stocks. Now, if that were true, if we were to live in a world where the CAPM was the true model, then the true asset pricing model, then this would have very profound and simple implications for portfolio construction. Well, to see this, just take a look at the Sharpe ratio of the portfolio. What you need to be able to estimate critically is mu I minus RF. Shows up at the numerator of the Sharpe ratio for the portfolio. Well, mu I minus RF, according to the CAPM, is nothing but beta I times mu m minus RF. And the mu m minus RF, being the same for all stocks, factors out. So in the end, maximizing the Sharpe ratio is just equivalent to maximizing the ratio given by the weighted average of the betas of individual stocks, sum of WI beta I, which is nothing but the beta of the portfolio, divided by portfolio volatility. So that's a very simple prescription, and using a good estimate for the covariance matrix and good estimate for the betas, then you have everything you need to optimize the portfolio. Well, the problem, though, as we know, is that we do not live necessarily in the multi-factor world, as we will see, in a single-factor world, as we will see, and therefore we will need to revisit this assumption of the CAPM being the true asset pricing model. Now, before we do so, just let's take a look at the kind of estimates you get. So in this context, we are using the 30 industry portfolio from the Kenneth French library, data library, which is available on his website. So you get 30 sector indices. And we are looking at 5 years worth of monthly data from 2013 to 2018. And this table actually contains 2 types of estimate for expected return. The first column is precisely given by the CAPM-based estimate for these expected returns, using an estimate for beta based on this sample of data, and also an estimate for the risk-free rate and the market risk premium on the same sample. The same way, we are shifting to the column number 2. We are looking at the competing estimate for expected return, which is given by the historical mean. Simply looking at the sample mean value over this 5-year period of time. Now, clearly, as we can see, the CAPM-based expected return estimates are much more reasonable. Much more reasonable. In particular, the range of those estimates is much smaller compared to the range of estimates that you get with the sample mean. With the sample mean, you get a negative, the worst or the lowest value that you get is minus 14.88%, which just does not make any sense in terms of an expected return estimate. Well, minus 14.88 is just happens to be the realized return on that particular sector index that did particularly poorly over the sample period. But of course, that does not imply that minus 15% would be a reasonable estimate for that sector index expected return looking forward. In contrast, if you look at what happens with respect to CAPM-based estimate, the range is much smaller. The minimum is around 5.76. So we're looking at things that are much more reasonable numbers. Those more reasonable expected return estimates translate into more reasonable portfolios. So if you start to maximize Sharpe ratios based on either CAPM-based expected returns or historical mean expected returns estimates for the same covariance matrix, which is the sample-based covariance matrix, then you find portfolio weights that are very different. And in particular, the historical weights which show up in orange on this graph show a much broader variation. Some of those weights are as low as minus 50% or even worse than minus 50%, and the most positive ones are above 50%. We're clearly looking at an extreme, not well balanced, not very reasonable portfolio. Now, if you look at CAPM-based estimates, because they are more reasonable, they give you a portfolio which is much better behaved. You still see a number of short positions that eventually we may want to deal with, but that's going to come later on. Now, moving on from the CAPM single factor model, given that we know that the world is better explained in terms of multi-factor exposures, then we might be tempted to use Steve Ross arbitrage pricing theory, which is some kind of arbitrage pricing model, asset pricing model that gives us a particular expression for what the expected return should be. That expression is actually generalizes the CAPM equation to the multi-factor setting. And this equation tells us that the excess expected return on a given stock is given by the sum of the product of the factor exposures of that stock with respect to all rewarded factors times the reward on those factors, the excess return on those factors, as can be seen from this equation. Now, the problem, though, if you want to be using that equation in the context of optimizing the Sharpe ratio, the problem is you need to be able to estimate the excess return or the Sharpe ratios lambda k of those factors, which wasn't really the case when you had a single factor, because that excess return on the market, you didn't even need to know what it was. It factored out, and we didn't need to estimate it for optimizing the Sharpe ratio of the portfolio. When you're moving on to multi-factors, yes, then you need to estimate those excess return or risk premia on factors, and that's not good news, because estimating expected return on factors is as difficult as estimating expected returns on individual components of the portfolio, if you will. So we're kind of back to square one. So what do we do in terms of estimating these expected returns? Well, there are different options. Option number one, which is an agnostic approach. If you don't know how to distinguish between these factors in terms of expected returns, you may want to assume that these expected returns are all equal for these factors. Well, that may not be necessarily the most reasonable choice, given that some factors are riskier than others. So the agnostic prior will actually tell you that you should assume that all of these factors have the same Sharpe ratio, the same reward per unit of risk. So that's you kind of giving up in trying to distinguish factors in terms of which one has the highest reward per unit of risk. You're saying, well, the data is not very informative, so I'm going to assume they're all equal. Well, the alternative would be to take a look at the data precisely, but take a look at not a small sample, but the long sample, the longest possible sample. And then you may want to look at the Sharpe ratio for all of these factors over the longest possible sample. And by looking at this, you may come to the conclusion that some of these factors have a higher reward compared to other factors per unit of risk, and you may want to use that information or that piece of information to kind of optimize your portfolio. Well, then there's a last approach, let's call that the active approach, whereby we recognize that it might actually precisely be the value of an active portfolio manager to be able to express meaningful, forward-looking views about the Sharpe ratios of these factors. And in which case, then, we are going to be using the active views generated by the managers based on some qualitative analysis or perhaps quantitative analysis. Well, that's precisely the skill of active portfolio management, to be able to make those calls in terms of forward-looking estimates for active returns. Well, wrapping up, factor models can be used to obtain meaningful estimates for expected returns on securities. The bad news, though, is when there's more than one factor in your factor model, you then need to have to rely on meaningful estimate of expected return on factors. And well, if you have at your disposal active managers, well, you may kind of want to turn to them and ask them, to generate active views for these factors. Alternatively, you may want to be using some agnostic prior, assuming that all factors have the same reward per unit of risk, or do something based on simple historical data.
All right, folks, and welcome back. We have covered a lot of ground, and I think it's kind of nice that we end up with risk as the last thing I want to cover. I'm going to keep this lab session intentionally quite short, because I really want you to take the time this week to go back over everything that we've done, not just in this MOOC, but if you haven't, to go back to MOOC 1 as well. And the first part of this two-part sequence, to really think about all the ground we've covered. We've generated hundreds of lines of code. I hope you've had an opportunity to modify it, fix any bugs you might have found, enhance them, and really started getting a visceral understanding of how these things really work. It's only when you actually start coding it and playing with the code and fixing problems yourself that you really gain an understanding of the underlying intuition and the mechanics of how these algorithms work. So I think it's really nice because I want to sort of end this entire sequence with risk. And I know that Lionel also loves this quote. This is one of my favorite quotes about finance, actually. And the word risk derives from Italian. The part that I really like about this quote is risk is a choice. It is not a fate. And I cannot tell you how many times I have talked to people who are like, oh, I don't want to take any risk. I understand that. They mean that in a colloquial sense of the word risk. Nobody likes risk. But I want you to think about risk not in the colloquial sense of the word, but risk as really a decision that we're making, and we're choosing what risks we can take because the expected returns that we can expect are directly tied to those choices. And so if you're looking for expected return, you got to start with what risk you're taking. That's why I like factor investing. That's why I like this way of thinking about risk. So anyway, enough philosophizing. Let's get to the actual stuff. I took the liberty of putting this there because I happen to know that Lionel likes this quote as well, as do I. Okay, let's get to the meat of this stuff. What are we really trying to do? So the first thing I'm doing here is just loading up the data, which we've done 100 times so far. This is really the part I want you to pay attention to. I'm only running this over a narrow period of time right now. So I've got this thing called RETS. This variable contains data since 2013. So just a short time, 2013 through 2018, right? And I'm building a covariance matrix out of that. Okay. Once I've got that, what I can do is I can look at the risk contribution. The contributions are really the formula that you saw in class, that Lionel gave you in class, is the percentage contributions of each one of these components, right? So given a set of weights and given the covariance matrix, we already know that the total risk, the total portfolio variance is this. And by the way, we're saying risk here when really we should be talking about variance. But this is the total portfolio variance. Whoops, sorry about that. This is the total portfolio variance. So what we're trying to do here is we're trying to decompose that into the rows of that matrix, right? So this is sort of, this we know is nothing more than W times covariance times W transpose. So all we're trying to do is now, so if you think of it as the W's times each cell of that matrix, Wi times Wj times sigma ij, which is that cell sigma ij is a cell in that matrix. All we're trying here in the rest of this is to decompose it row by row, right? That's all we're doing. So the marginal contribution is just that fraction that comes out of a particular row, right? So that's what that is. And you can see that the risk contribution is just nothing more than the marginal contribution multiplied by the weight transpose. Okay, and you look at that as a fraction of the total portfolio volatility. So this is nothing more than it doesn't directly map in terms of lines of code, but this is nothing more when you actually work out the matrices. This is nothing more than the exact same formula for the PIs, right? And this is the total portfolio variance. Okay, so these are the individual risk contributions due to each constituents of the portfolio. Okay, so now what I'm doing is let's take the equally weighted portfolio of these returns. So that's nothing more than I'm going to give equal weight in all these portfolios. And do all of these things contribute equally to risk? And the answer is of course not. So if you want a less risky portfolio, you don't want to, you won't have as much impact by reducing the weight in beer, because that's really not where the volatility is coming from. The volatility of the portfolio is coming more from finance than from beer. That's the way I want you to think about risk contributions. Okay, I hope that intuition is clear. So this function, risk contribution, helps you clearly say what are the individual contributions. So these are the PIs in that formula that you saw in class. Okay. Now, what is an equal risk contribution portfolio? Well, all you're saying is figure out what are the weights so that the contributions of each one of these are the same. So clearly, the weights of beer has to go up. The weights of finance has to go down in some ways. The reason I can't just do it simply by adding and subtracting here is because of the effect of the covariances, right? Because if I increase the weight here, it's going to decrease the weight of something. It's going to decrease the contribution of all these other things. So they're all interconnected by the covariances. And that's why just there's no closed form formula for this. It's a much more complicated thing. But fortunately, we have our good friend, the quadratic optimizer, which we've seen now many times. And so all we do is pull that back. So I want to just sort of explain to you how we're rerunning the quadratic optimizer. So what I'm doing here is I'm going to say target risk contributions. What I've done here is a little different from what we did in class. I've generalized it slightly. Instead of doing equal risk contributions, I've written a function that can give you any specific target risk contribution. So it doesn't have to be equal. You can actually say, I want my risk contributions to be 30% from beer, 20% from this, 25% from this, so on and so forth, right? So I've generalized that, and then I'm going to show you in a second how I'm going to build equal risk contributions out of that. So I thought it might be more fun to do it this way, because then you can even build portfolios that have specific risk contributions of each of the components. So that's why I call it target risk contributions, and you give it the target risk, right? So 25, 30, 35, whatever you want to do for each of the components. Make sure they add up to 100, but that's pretty much it. Okay, so now I've got my target risk contribution. So all I'm doing here is running our friend, the quadratic optimizer, right? And I'm calling minimize, which we've seen a few times now from scipy.optimize. But what is the objective function? The objective function is this thing called MSD risk, which is, why did I call it MSD risk? Because it's the mean squared difference in risk is what I'm trying to minimize. So what I'm going to do is I'm going to compute a portfolio. I'm going to compute the risk contributions of a portfolio with a set of weights. I'm going to compare it to the target portfolio. So this is what I'm doing here. So I have my contributions due to this weight. So given a set of weights, it will produce through this function that we've already seen the contributions due to the weights. And I'm going to take the weight, the risk contributions due to that weight and compare it to my target. And I'm going to compute the difference between the two. I'm going to square it, and then I'm going to compute the sum of that, right? So this, and I could divide by this, but this is, I guess I should call it TSD, total squared difference, instead of mean squared difference. But of course, the total is directly proportional to this, so it doesn't matter, right? We'll get the same number. We'll get the same solution. Okay, so that's really what's going on here. So you give it a set of target, it will the optimizer will compute a set of weights. What you do next is you compute the risk contributions implied by those weights. You look at the difference, the mean squared difference between the risk contributions implied by the weights and the target contributions that we want. And when you've now got your least squared OLS type metric, right? You've got a measure that increases when the deviation between those two increase, and so on. And so what you want to do is you want to minimize this. Okay, good. So this should again all be familiar to you because we've done this now several times. Only thing that I've changed is change the objective function. All right, so now that function gives me the optimal weights given a target risk, but we said we wanted equal risk contributions. Well, that's super, excuse me, that's super easy. All you do is equal risk contributions is nothing more than the target risk contributions when the target risk is all exactly the same. It's just 1 by n. The target risk contributions of each of the n constituents is exactly 1 by n. That's really what equal risk contribution is. But I like the idea of doing target risk contributions first, just because I think it's nice to do it this way. Okay. I'm sure there are other ways of doing it, but this is the way I like to think of it. So let's look at it, right? So what did we do here? Let me go back to this. Just remind you what we did here. What we did is we computed the risk contribution given equal weights and a given covariance matrix, and I plotted a bar chart out of that. Okay. Now I'm going to do the exact same thing. I'm going to plot the risk contributions, but instead of the equal weights, I'm going to give it the weights that give us equal risk contribution. And if we did our job right, these bars should all look the same. And so let's test that. It's just a verification. So that's exactly what I'm doing. So I'm doing equal risk contributions based on that covariance matrix, right? And the covariance matrix itself, of course. And so if I look at the risk contributions of weights that should give me equal risk contributions, are the risk contributions equal? That's a tongue twister. So Peter Pepper picked up pipe of pickled peppers. I don't know. This might be just as easy to say. Anyway, we have it here. And as you can see, yes, we've got now these weights are giving us equal risk contributions. And so clearly that optimizer found a solution that worked. Okay, good. So now I can use this function to build a weighter. Right? We can backtest these things. We can now build, we can use this as a strategy, and we've already got the mechanics to be able to backtest any strategy as long as you can write a function that produces those weights. So that's exactly what I've done here. So this is exactly like we've done weight EW, weight CW, weight GMV. I've got a new one here, which is weight ERC. So weight ERC just basically says, you give me a set of returns and you give me some way to estimate the covariance matrix. Well, I'm just keeping it simple. I'm using the sample covariance here. You can actually give it any covariance estimator you want, and that might be a fun thing to do. Anyway, you do that. And what does it do? Well, all it's doing is estimate the covariance matrix, and then it's calling the code that we just wrote to produce the weights that give you equal risk contributions based on this covariance matrix. And then what I've done is I've run the backtester on that, and I've compared it with equally weighted cap weighted, and my backtest results are this. And of course, this is just the standard one that we've already done in the past, equal weighted and cap weighted, right? And then I'm running it for the ERC strategy. Again, all of these things, just make sure that they have the same estimation window, right? You're estimating it over 3 years of returns. That's how you estimate the covariance matrix. And then you build the returns, convert the returns to an index, to a wealth index, and you produce the summary stats for that. And you can see that, let's see, over this period, what did we get? So we got ERC gave us slightly better returns than equally weighted. So, well, no, actually it gave you about the same returns as equally weighted, 12.0 compared to 12.1%, but with lower volatility. So it should have given you a better Sharpe ratio. So you got a slight improvement in Sharpe ratio over this period, etc. And you got a slight reduction in max drawdown. So again, these are things that work really well if you have individual stocks, because they have a lot of individual idiosyncratic volatility that you can wash out through these techniques of better diversification. So play around with this. I thank you very much, and I hope this was enjoyable. Hope to see you at some later course someplace, and otherwise wish you all the best. Thank you. Bye.